Welcome to the Deep Dive. This is where we take the information you send us, unpack it, and really get into the details.
That's right.
And today, we're diving into something that's clearly top of mind for many of you, generating income through investments. We get a great collection of sources you provided.
Yeah, a really rich set. Our goal here is to pull out the key insights, maybe some surprising facts, and definitely some actionable ideas for you. Think of it as a way to quickly get up to speed on making your money work harder.
It really resonates, doesn't it? I was
Yeah.
looking at that 2018 Federal Reserve report mentioned in the materials. It found, less than 2/5 of non-retired adults felt their savings are on track.
And it gets worse.
Yeah, and nearly 3/5 of those managing their own investments felt uncomfortable doing it.
Right. And when you add in the fact that the average retired couple might need around $3,800 a month just for expenses,
Yeah,
well, you can see why finding reliable income is so crucial.
exactly. That potential gap is what worries people.
So that's our mission today, to explore these different investment strategies you've highlighted, strategies that can help you bridge that gap and turn your capital into a more consistent income stream.
Okay, great. Let's dive right in then. The first sort of big idea that comes through is the power of income investing itself. What's the core concept there?
Well, at its heart, income investing is about choosing investments specifically because they pay you cash regularly.
Cash. So dividends, rent, that kind of thing.
Exactly. Dividends from stocks, maybe rent from property, though we'll see ways to do that without being a direct landlord or even royalties. The main goal is building up income streams that are safe, reliable, and predictable, the kind you want for a comfortable retirement.
So it's less about betting on a stock price soaring and more about the regular cash it throws off.
Precisely. Look, compound interest from investing early is fantastic, no doubt. But if you're closer to retirement or already in it, income investing is really the next best thing. It's about making the capital you have generate the income you need.
Okay. Now, a really key point in the sources you send is that we shouldn't just stick to the usual suspects investment-wise.
Oh, definitely not.
What are some of these strategies that maybe fly under the radar a bit?
Yeah, that's a great point. So many people think, okay, 401k, bonds, maybe some blue chip dividend stocks, and that's kind of it.
Right.
But the world of income investing is honestly much broader and frankly more interesting than just those options.
And one area that really jumped out at me from your notes was business development companies, BDCs. They're called off-Wall Street banks. What's the story there?
Yeah, BDCs are fascinating. They basically lend money to small and medium-sized businesses. You know, the kind of companies that traditional banks might see as too small or maybe a bit too risky for their standard loan criteria.
Okay, so they're filling a gap, but if it's riskier, how does that work for investors?
Well, because they're taking on potentially higher risk, BDCs can usually charge higher interest rates on those loans.
Ah, okay. Higher interest rates for them, potentially higher dividends for investors. Is that the idea?
That's exactly the idea. To compensate investors for that extra risk, BDCs often pay out pretty generous dividends. We're talking yields that can be significantly higher than your average S&P 500 company. Ars Capital, for instance, was mentioned in the sources. It's had yields over 9%.
Wow, over 9%. But what about managing that risk you mentioned?
Good question. They have ways. Many use something called senior secured loans.
Senior secured. What does that mean practically?
It means if the company they lent to defaults, the BDC is basically first in line to get paid back from the company's assets. It gives them a better chance of recouping their investment compared to other lenders or shareholders.
Okay, so they have a priority claim. Makes sense.
Right. And BDCs often don't just lend the money and walk away. They tend to be quite involved, almost like a private equity firm sometimes. They might sit on the board, get regular updates, provide guidance.
Trying to help the company succeed, which helps their loan get repaid.
Exactly. Another interesting feature is that a lot of BDC loans are floating rate.
Floating rate. So the rate changes.
Yes, it adjusts based on benchmark interest rates.
Mm-hmm.
So if overall interest rates are going up, the income the BDC receives can also go up, potentially leading to higher dividends for you.
Oh, that's useful in a rising rate environment.
It can be, but it's important to remember with BDCs, the main focus is usually the income. You might not see huge jumps in the actual stock price itself. It's primarily an income play.
Got it. Income first. Okay, so moving from lending money to owning things. Let's talk REITs, real estate investment trusts. The idea of collecting rent without the landlord hassle is pretty tempting.
It really is a popular concept for income investors. So REITs are companies that own and operate real estate that produces income. Could be anything, apartment buildings, shopping centers, healthcare facilities, data centers, you name it.
And the key for income is?
The key is they have a legal requirement. They must distribute at least 90% of their taxable income back to shareholders as dividends.
90%. Okay, that explains why the yields can be higher.
Exactly. It often pushes their dividend yields above what you'd get from a typical stock.
And you get that slice of rental income, but without fixing toilets at 2 a.m. Plus, I assume they're easier to buy and sell than an actual building.
Much easier. That's the liquidity benefit. You buy and sell REIT shares on the stock market, just like regular stocks. Much simpler than dealing with property deeds and closings.
Okay. Now, the sources mention different types of REITs. It's not just one big category.
Correct. They specialize. Let's maybe start with one focus on government properties. Easterly government properties, DEA, was highlighted.
Right, DEA. What's compelling there is who their tenant is. The U.S. government, FBI, Homeland Security, these agencies.
Talk about a reliable tenant.
Exactly. The risk of the government defaulting on rent is, well, about as low as you can get. It makes for a very stable income stream. And apparently, the GSA, the government's landlord arm, actually leases way more space than it owns now.
Interesting trend. So REITs like Easterly are positioned to meet that need. Rent checks backed by Uncle Sam, definitely lower risk. Okay, what about the one favored by a certain famous investor from Omaha?
Yes, Store Capital. Store. Berkshire Hathaway, Warren Buffett's company, owns a decent chunk of it.
Which says something.
It does. It suggests even a value investing legend sees potential in physical retail, if it's the right kind. STORE stands for Single Tenant Operational Real Estate. They use a net lease model.
Net lease, meaning the tenant pays most expenses. That's right. The tenant is usually responsible for property taxes, insurance, maintenance on top of the rent. STORE focuses on tenants that are financially solid and often builds rent increases right into the lease agreements.
So steady income and potentially growing income. Smart.
And focusing on tenant quality adds that extra layer of safety. The sources also mention REITs playing into demographic trends, like the aging population.
Yeah, that makes sense. As more people get older, demand for senior living and healthcare services goes up. Welltower, was mentioned. Big player in senior housing, apparently with a good dividend track record.
Right, consistent payouts.
And Healthcare Realty Trust, HR, focusing on medical office buildings. Another area likely to see growth with an aging America.
So investing in these is kind of like aligning your portfolio with major societal shifts. What about the digital world? Data centers.
Yes. The backbone of the internet, cloud computing, all that. Digital Realty Trust, DLR, invests in these massive data facilities. They rent space to big tech companies, financial firms.
Essentially, the real estate needed for the online economy.
Pretty much. As we rely more on digital services, the need for data storage just keeps growing. So potentially a very attractive sector long term.
The digital landlord, providing critical infrastructure. Okay, now a slightly different flavor. Hotel REITs, maybe a bit more sensitive to the economy?
Yeah, Chatham Lodging Trust, CLDT was the example. You'd think hotels would be hit harder by recessions or travel slowdowns.
That's generally true. Chatham's model often involves leasing the hotel space rather than operating the hotels directly, which can sometimes lead to high yields like the 7.2% mentioned from mid-2019. But yes, their performance is definitely tied more closely to travel trends and the overall economy. They use different kinds of leases too, mixing things up.
So potentially higher yield, but maybe more cyclical.
And just quickly, the sources did caution about mortgage REITs, the ones investing in mortgages, not buildings. They tend to be much more sensitive to interest rate swings and defaults. Higher risk there, usually.
Good distinction. Okay, we've hit physical buildings, digital infrastructure. Let's shift to energy. Master limited partnerships, MLPs. The idea of potentially tax-free energy income sounds intriguing.
It does, doesn't it? So MLPs mostly operate in what's called the midstream energy sector.
Midstream, meaning?
Transporting and storing oil and natural gas. Think pipelines, storage terminals. Because they're providing the infrastructure, they're often less directly exposed to the wild swings in oil and gas prices compared to companies actually drilling for it.
Okay, so they're like toll collectors on the energy highway.
That's a good analogy. And the big draw for income investors is their structure. They're typically set up to pass through most of their income, often over 90% directly to investors. And importantly, that income can often be exempt from federal income taxes.
Wow, okay. So income from essential infrastructure plus the potential tax break.
Yeah.
Energy transfer, ET, was mentioned as one.
Yeah, ET has a huge network of pipelines and facilities. Historically, it's offered pretty high yields. Now, one thing to keep in mind with MLPs is that building all that infrastructure often means taking on significant debt.
Right, pipelines aren't cheap.
No. And for investors who want diversification within the MLP space, there are ETFs like the Alerian MLP Exchange, AMLP, that hold a basket of them.
Okay, so MLPs offer a unique way into energy income, potentially tax-advantaged, but be mindful of the debt. Got it. Let's pivot to some stock market strategies now, starting with the dogs of the Dow, kind of a funny name. What's the logic?
It's actually a very simple strategy. At the start of the year, you look at the 30 stocks in the Dow Jones Industrial Average, find the 10 with the highest dividend yields, and invest equally in those 10.
The highest yielding 10. Why
Right.
those?
The theory is that a high yield on a blue chip Dow stock often means its price has fallen recently. It's underperformed. So the high yield might signal that the stock is undervalued and could be due for a rebound.
Ah, so it's a bit contrarian, buying established companies when they're maybe a bit out of favor.
Exactly. And historically, this straightforward approach has actually tended to outperform the overall Dow average over long periods.
Oh, it's interesting.
Yeah. While the Dow's average yield might be, say, around 2%, the dogs often yield somewhere between 3% and maybe 6%. Plus, it's low maintenance. You basically buy and hold for the year. Low turnover, low costs.
Simple, potentially higher yield from big names, low effort. Sounds appealing. Okay, sticking with dividends, your sources mentioned dividend achievers and aristocrats. Very regal-sounding titles.
They certainly represent the royalty of the dividend world. Dividend achievers are companies that have increased their annual dividend payout for at least 10 years straight.
10 years. Okay.
And dividend aristocrats take it even further. They have a track record of at least 25 consecutive years of dividend increases.
25 years. Wow.
Yeah. These are companies with an incredibly long and proven commitment to returning cash to shareholders year after year through thick and thin. Investing in them, maybe through an ETF like NOBL, the ProShares S&P 500 Dividend Aristocrats ETF, gives you exposure to that reliability.
That consistency really says something about their business stability. Okay, interest rates keep coming up. Let's talk about floating rate funds. How do they work in this environment?
Right. So floating rate funds invest in loans where the interest rate isn't fixed. It adjusts periodically based on a benchmark rate like SOFR these days.
Unlike a traditional bond where the payment is fixed for years.
Exactly. So the appeal is if interest rates are rising, the interest payments the fund receives on its loans can also rise. This can help protect your income stream from being eroded by inflation, unlike fixed rate bonds whose value can fall when rates go up.
Okay, so income can potentially go up as rates go up. The Fidelity Floating Rate Fund, FFRHX, was an example.
Yes. Now, it's important to understand how they often get those potentially higher yields. These funds typically invest in loans made to companies with lower credit ratings, maybe B or BB rated.
Lower credit ratings mean higher risk.
Generally, yes, there's a higher risk that the borrower might default compared to, say, investment grade companies. So you're getting potentially more income, but you're also taking on more credit risk. Need to be comfortable with that trade-off.
Higher potential yield, but definitely need to be aware of the increased default risk.
Okay. Moving into something that sounds a bit more complex, covered calls. How does this generate income?
It can seem intimidating, but the basic income idea is pretty simple. If you own shares of a stock, say 100 shares, you can sell someone else the option to buy your shares at a specific price, the strike price, by a certain date. This is called selling a call option.
Okay, you sell the option. And in return for selling that option, you immediately receive cash, which is called the premium. That premium is income you get to keep regardless of what the stock does next.
Ah, so you get paid upfront for potentially selling your stock later.
Exactly. Now, if the stock price stays below the strike price you agreed on, the option just expires worthless, and you keep your shares and the premium you collected. Extra income.
Okay, but what if the stock price shoots up?
That's the trade-off. If the stock price goes way above the strike price, the person who bought the option will likely exercise it, meaning you have to sell your shares at that lower strike price. So you keep the premium, but you miss out on any further gains above that strike price.
So you cap your potential upside in exchange for getting that premium income now.
Precisely. It's a way to generate potentially much more income than just the stock's dividend alone. And there are funds that do this for you, like the BlackRock Enhanced Equity Dividend Trust, BDJ, or Cohen & Steers Global Income Builder, IMB, which were mentioned. They manage a portfolio and sell calls on the stocks.
Interesting strategy. Extra income, but you might give up some big gains. Okay, what about Liberty checks? Or special dividends. Sounds like a bonus.
They can feel like one. A special dividend, or Liberty check, as some call it, is basically a one-time payout from a company that finds itself with a lot of extra cash. It's separate from their regular, predictable dividend.
Like finding money in your coat pocket.
Yeah.
The sources mentioned some potentially huge yields, like 40%.
Yeah, those super high ones are rare, but even special dividends offering, say, 4%, 5%, or more can be a really nice boost to your return for that year. The strategy often involves just holding stocks you like and hoping for these occasional windfalls.
But you need to know why they're paying it, right?
Absolutely critical. You want it to be from strength, like massive profits. Sometimes companies pay a special dividend because they sold off a division or something. That's less indicative of ongoing health, so you need to dig into the why.
Look beyond the headline yield. Got it. Okay. Gold royalties. Gold itself can be volatile, so how does this work for income?
Right. Instead of buying gold bars or even gold mining stocks directly, you invest in companies that finance the miners.
Finance them. How?
They provide upfront cash to mining companies to help them develop or expand a mine. In return, the royalty company gets the right to a percentage of the gold that mine produces over its lifetime. That's the royalty. Or sometimes they get to buy a portion of the gold produced at a deeply discounted fixed price that's called a stream.
Ah, so they're like the financiers taking a cut of the production without actually having to run the mine. Franco-Nevada, FNV, was mentioned as a big player.
Exactly. FNV is a pioneer. This model gives them diversification across many mines and projects, which reduces risk compared to a single mine. And it can provide a more predictable income stream than owning mining stocks directly, since the royalty company isn't bearing the direct operating costs and risks of mining.
Interesting angle. Income tied to gold production, plus maybe that diversification and inflation hedge aspect of gold itself.
Precisely. Now, let's maybe shift gears to some less traditional income sources. Peer-to-peer lending was in the materials.
Right, P2P, where individuals lend directly to other individuals online.
That's the idea. Platforms like Prosper or LendingTree connect borrowers needing loans with investors, like you, willing to fund those loans. The potential benefit for you as the lender is earning a higher interest rate than you'd likely get from a bank savings account because you're cutting out the bank middleman.
Okay, higher potential interest. But I assume there's more risk. You're lending to individuals.
Definitely more risk. The main one is borrower default. But the platforms usually provide a lot of information about the borrowers, their credit history, the loan purpose, and assign a risk grade. You can typically choose which loans to invest in and, importantly, diversify by putting small amounts into many different loans.
Spreading the risk.
Exactly. And some platforms might offer options with FDIC insurance, though you need to check the specifics carefully.
So a more direct way to earn interest, but requires careful vetting and diversification.
Yeah.
Okay, what about high-yield checking accounts, like Kasasa? I thought checking accounts paid basically nothing.
Most do. But some community banks and credit unions, especially those trying to compete online, offer these special high-yield checking accounts. They use them to attract deposits.
And they actually pay decent interest.
Surprisingly decent sometimes. Kasasa was an example. They've offered rates around 4%, which is way better than the big national banks. Usually you have to meet certain criteria each month, like making a certain number of debit card purchases or having direct deposit set up.
Okay, a few hoops to jump through, but 4% on checking is pretty good.
It is. It might not be a huge amount of money overall, but it's a much better return on cash you might need to keep liquid anyway. And, importantly, these are typically FDIC insured up to the standard limits.
Good point. Every bit helps. Now, a really niche one, legal marijuana REITs.
Yeah, this is a newer development tied to the expanding legal cannabis industry. Innovative Industrial Properties, IIPR, was mentioned. It's a REIT that specializes in buying and leasing industrial-scale properties used for growing and processing medical cannabis.
So providing the real estate for a booming, though still complex, industry.
Exactly. As more states legalize, there's a growing need for specialized facilities. REITs like IIPR cater to that. It's definitely a growth area, but also comes with unique regulatory risks and the uncertainties of a relatively new industry.
A specialized play, for sure. Okay, let's talk about boosting the dividends you already receive. Dividend reinvestment plans, DDRIPs.
DDRIPs. A really powerful yet simple tool for long-term growth. When you're enrolled in a DRIP for a stock you own, instead of getting the dividend paid out as cash.
It buys more stock automatically.
Exactly. That dividend payment is automatically used to buy more shares or even fractional shares of the same company.
So your number of shares keeps growing without you doing anything.
Right. And then those new shares start earning dividends too. It creates this wonderful compounding or snowball effect over time. You end up with more shares, generating larger future dividend payments, which then buy even more shares. Especially powerful if you start early.
And you buy more shares when prices are low, fewer when high. Kind of automatic dollar cost averaging.
That's another benefit. Plus, they're usually free to set up through your broker or the company's transfer agent. Just remember, even if reinvested, those dividends are still generally taxable income in the year you receive them, unless it's inside a tax-advantaged account like an IRA or 401k.
Good point on taxes. Simple, effective for long-term growth.
Mm-hmm.
Now, closed-end funds, CEFs, described as billionaire favorites. What makes them special?
CEFs are a different kind of fund structure. Unlike mutual funds or ETFs that can create or redeem shares daily, a CEF issues a fixed number of shares at its IPO, and then those shares trade on the stock exchange like individual stocks.
A fixed number of shares. How does that make a difference?
Because the number of shares is fixed, the market price of the CEF can drift away from its net asset value, or NAV, which is the actual underlying value of all the investments the fund holds.
So the price you pay might not match the value of what's inside.
Exactly. Sometimes the market price falls below the NAV. This means you can potentially buy the fund at a discount, essentially buying, say, $1 worth of assets for maybe 90 or 95 cents.
Buying assets on sale. That sounds attractive.
It can be. It offers a potential immediate return boost and maybe a bit of a safety margin. CEFs invest in all sorts of things: bonds, stocks, preferreds, real estate, and they often aim for higher distribution yields than typical mutual funds or ETFs.
What's the catch?
Well, a couple things. Many CEFs use leverage, borrowed money to try and boost returns, which also increases risk if things go wrong. And their expense ratios can sometimes be higher than ETFs. So you definitely need to look closely at the discount premium, the leverage, the fees, and the distribution policy. River North Double Line Strategic Opportunity Fund, OPP, was an example mentioned that sometimes trades at a discount.
Okay, potential for discounts and high yields, but watch out for leverage and fees. Makes sense. How about preferred stocks? You mentioned CES might hold them. They're like a hybrid.
That's a good way to put it. Preferred stocks sit somewhere between common stocks and bonds. Like a bond, they usually pay a fixed dividend, which is set as a percentage of their par value. That dividend payment is more predictable than common stock dividends, which can vary.
Okay, fixed dividend like a bond. How are they like stocks?
They represent ownership in the company, though usually without voting rights. But the key thing for income investors is their preference. Preferred stockholders must receive their dividends before any dividends can be paid to common stockholders.
Ah, higher up the payment chain.
Yes. And if the company were to liquidate, preferred holders also get paid back before common stockholders after bondholders. They're often issued by banks, insurance companies, utilities, telecoms, and can offer higher yields than the company's common stock or its bonds sometimes.
So more predictable income than common stock, more secure dividend payment, potentially higher yield.
Interesting. Okay, the sources then took a slightly different tack, looking at investing in solar power. How is that an income strategy?
It's more about income through savings, really. By putting solar panels on your roof, you generate your own electricity, which drastically reduces or even eliminates your monthly electric bill. That saving is like tax-free income.
Cutting a major expense. Exactly. And in many places, if you generate more power than you use, you can sell the excess back to the utility grid through net metering. That generates actual cash flow.
Okay, so savings and potential earnings.
Yeah.
What about the cost? Solar isn't cheap.
True. There's an upfront investment. But government incentives, like federal tax credits, can significantly lower that net cost. The sources mentioned payback periods, potentially in the 6 to 9 year range, after which the electricity is essentially free. Plus, it generally increases your home's value.
So a longer-term play with environmental benefits, too. Depends on your house and location, I guess.
Absolutely. Roof direction, shading, local sunlight levels, utility rates, all factors.
Okay. What about the classic income property route? Becoming a landlord.
Owning rental properties is definitely a well-trodden path to building income and wealth. You buy a property, rent it out, and the rental income hopefully covers the mortgage, taxes, insurance, upkeep, and leaves you with a profit each month. Plus, you potentially benefit from long-term property appreciation.
Sounds good in theory, but it's work, right?
Oh, absolutely. It's not passive income usually. You're either managing the property yourself, finding tenants, collecting rent, handling repairs, or you're paying a property manager, maybe 8–12% of the rent, to do it for you.
So you trade time or money for that income stream.
Exactly. Location is critical, the type of property matters, single-family, multifamily, condo, and you need to be prepared for vacancies and unexpected expenses. It's a business, really.
A hands-on business.
Yeah.
Okay. Lastly, the sources included some top stock picks for the next 10 years. We obviously can't give specific advice, but what kinds of companies were on that list, just as examples?
Sure, it was a mix, mostly large established companies known for dividends or steady growth. You had tech giants like Apple, AAPL, service companies like Paychex, Payways, and Payroll HR.
Yeah.
REITs were there too, like Stag Industrial, Stag, focused on warehouses potentially benefiting from e-commerce, and WP Carey, WPC, a diversified REIT with a long dividend growth history.
Diversify.
Yeah. Also, logistics with UPS. Even sectors facing challenges like Altria, MO in tobacco, known for its very high yield. Regional banks like People's United, PBCT, with decades of dividend growth. And healthcare through CVS Health, CVS, which is much more than just a pharmacy now.
So really a broad mix across different industries, but generally focused on established players with track records or strong positions.
That seems to be the theme, yes. Companies that are expected to continue generating cash and returning some of it to shareholders over the long haul.
Well, that was quite a tour. We've covered a lot of ground, from BDCs and REITs to covered calls and even solar power.
Absolutely. The goal, again, drawing from the materials you provided, was really to give you, our listener, a solid overview of the sheer variety of ways you can approach generating investment income. Because ultimately, earning more income is such a key part of financial freedom.
And it's clear there's no single best way. It really depends on you, your comfort with risk, your financial situation, how much time you want to spend on it.
That's the perfect summary. We really hope you'll think about these different options, maybe identify one or two that seem like a good fit for you, and start exploring them further. Taking that first step, making a plan, that's the most important part.
Definitely. If something specific caught your ear, maybe go back and listen to that section again. And for more discussion and support, the sources mentioned the Income Investors Facebook group. That's www.facebook.com/groups.incomeinvestors.
It's a great resource. So as we wrap up, thinking about all these possibilities we've discussed today, perhaps the key question for you now is this. With all these potential avenues for generating income out there, what's just one small step, one action you could take today to start building your path towards a more secure, maybe even an unlimited income future?